Hello, Paul Gerrard from Price Accounting Services. Welcome back to this further video in this quite extensive rental property investor series. This video concerns tenant contributions to rental expenses, and we'll discuss how that is treated for tax purposes. So, common issues where tenants might contribute to costs can include tenants who contribute to damage. So they damage a carpet, you fix the carpet, it's $1,000, and they then pay you $1,000, for example. The other one might well be insurance proceeds. It could be a number of other contributions, such as tenants paying for water use, or could even be a retention of a bond. So let's talk about that. With respect to retention of a bond, we've got to be very careful we're not confusing two issues here. When we're talking about a retention of a bond, we're talking about a tenant that loses some or all of their bond because they haven't maintained the correct property condition. For example, it's dirty, needs cleaning, or there's damage. Okay, that's a retention. When a client, let's say you receive 4 weeks rent from the tenant, or 2 weeks, whatever your state law says, you receive a couple of weeks of rent and you are then required to pay it into a state government fund or something. That's not a bond retention. Ignore that. That's not income, not an expense. There's nothing associated there. So we're talking about rental costs. The tax issue is this: you show it as assessable income. Then you claim the full amount of the rates paid, or the water, or whatever the cost might be, okay? Now, in some instances, there can be an anomaly. For example, the tenant may, well, for example, that carpet issue, the tenant might have caused $1,000 damage to the carpet. The carpet has been replaced. Now, that is not a repair, it's a replacement, okay? So that will be depreciable. The old carpet might be written off, the new one depreciated, but the contribution will be assessable income, and that's an unfortunate outcome. You can't net one off against the other. I also recently encountered a client question concerning a dishwasher. And they cut a deal with their tenant. The tenant said, look, I really want a new dishwasher. And he said, well, the one you've got works. And he said, yeah, but it's old, it's crappy, whatever. So the deal reached was, there was going to be no increase in the rent. The tenant would pay for half of the dishwasher. The owner was going to pay for the other half, and the tenant would leave the dishwasher when they vacate. So what happens there? Well, the $500 total cost, let's say, installed, let's say it's $1,000. The $1,000 cost would be depreciable from that date forward. The old one, if it's capable of being written off, we would write that off in the tax return. The new one's then depreciated. The $500 that the tenant contributes is assessable income, okay? So you don't reduce the depreciable value by the tenant contribution or anything like that. Unfortunately, it's assessable income. So I hope that explains a little bit about tenant contributions. There is a section in our tax checklist at the top near the rental income where you can list those contributions so that your assessable income is correctly adjusted, okay? So if you have any questions, speak to your tax advisor. We're more than happy to take those inquiries. If you've got any questions, subscribe to our channel, and we look forward to seeing you in another one of our videos soon. And check out heaps of other videos in this series in our playlist, and look forward to seeing you then. Until then, bye.